In the first 2 months of 2026, the XRP Ledger added $1.3 billion in tokenized real-world assets. That is more than the entire year of 2025. In 2 months, Societe Generale launched its Euro stablecoin on the Ledger. Aviva Investors announced a tokenization partnership with Ripple. Deutsche Bank integrated Ripple's technology stack. Goldman Sachs allocated nearly $154 million to XRP ETFs. And the price of XRP is down 30% year-to-date. Every institutional win, every infrastructure milestone, every record broken, and the chart barely moved. Either something is fundamentally broken with XRP, or this is the most misunderstood setup in digital asset markets right now. The answer is hiding in one specific data point that almost no one has looked at closely enough. Here's what makes this moment genuinely unsettling for anyone who thinks they understand the XRP investment thesis. The XRPL now hosts $3.5 billion in tokenized real-world assets. Crossing that milestone in a single 24-hour window last week, when Just Token's tokenized energy asset surged from $861 million to $1.76 billion on the ledger. Daily transactions on the XRPL hit 3 million on March 15th, a threefold increase from mid-2025 averages. RLUSD, Ripple's stablecoin, surpassed $1.5 billion in market cap. ARK Invest has allocated nearly 20% of its CoinDesk 20 ETF to XRP, making it the third largest holding in that fund. And none of it moved the price. So the question every serious XRP holder needs to answer is not whether the fundamentals are real. They clearly are. The question is, what is the specific mechanism that connects institutional infrastructure activity to actual XRP token demand? And right now, is that mechanism working? Because here is what the data actually shows. And it's the thing most bullish coverage on XRP won't say out loud. Most of that $3.5 billion in tokenized assets on the XRPL settles in stablecoins. Institutions using the ledger need only a fraction of a cent in XRP to pay network fees. That's it. They don't need to hold XRP. They don't need to buy XRP. They need the ledger. XRP is almost incidental. That is the honest read of the current data. So what does it actually take for the infrastructure growth to translate into XRP token demand? And is there a specific event or set of events that closes that gap? That is exactly what we're going to work through. And the answer is more specific than most people realize. This is XRP News Flow Signals. We track the on-chain data, the institutional filings, and the structural mechanics. And we give you the honest picture, not the one that tells you what you want to hear. Let's get into it. Let's be precise about what is actually happening on the XRP Ledger. As of April 24th, XRPL hosts approximately $3.5 billion in tokenized real-world assets, a new all-time high. In total, on-chain tokenized asset value, surpassing Solana, Polygon, and Avalanche. XRPL ranks second in 30-day RWA growth, trailing only Arbitrum. Those are real numbers. They are verifiable. But here's the structural detail that explains the price disconnect. The composition of that $3.5 billion matters enormously. Just Token's JMWH Energy Token, a tokenized megawatt-hour product backed by Latin American energy companies, accounts for roughly $1.76 billion of that total. It has 12 holders, not 12,000, 12. Control Alt's tokenized diamond collections add $189 million. Ripple's RLUSD stablecoin holds $348 million on the XRPL side. Commodities and stablecoins together account for over $1.2 billion. Ondo Finance, Guggenheim, and OpenEden hold roughly $300 million in tokenized U.S. Treasury products on the ledger. None of these products settle primarily in XRP. They settle in RLUSD, EURCV, or other stablecoins. The XRP the institutions need for those transactions. costs a fraction of a cent each. The XRPL's built-in DEX runs 27,000 AMM pools, and 92% of trades on it go through XRP pairs, which is structurally significant. But daily DEX volume still sits between $4 million and $8 million. Total DeFi value locked on XRPL, $47.5 million. The plumbing for XRP to become the global liquidity layer of a tokenized asset market is real and operational. The volume that would justify that role hasn't materialized yet. This is not a flaw in the thesis. It is the current stage of the thesis. And understanding the distinction is what separates informed positioning from narrative-driven speculation. But here's what changes that equation. And this is the part that most analysis skips because it requires connecting the infrastructure story to a specific supply mechanics event that most people haven't modeled correctly. That's next. Let's model something concrete. As of today, exchange reserves on XRP sit at approximately 2.6 billion tokens, a level last seen in 2018, down from roughly 4 billion tokens at the start of 2025. XRP spot ETFs, 7 of them now live in the US, have accumulated $1.53 billion in AUM. That locks approximately 773 million XRP in institutional custody. Each $1 billion in XRP ETF inflows locks roughly 500 million tokens in custody arrangements. At $5 billion in AUM, which JP Morgan forecasts as the first-year target, ETFs would hold roughly 2.5 billion XRP. That number, 2.5 billion XRP in ETF custody alone, is more than every crypto exchange combined holds today. Goldman Sachs already allocated nearly $154 million to XRP ETFs. ARK Invest holds XRP as its third largest position. Swiss institutional capital poured $120 million into XRP ETPs. Now here's the Blackrock scenario. Blackrock has not yet filed for an XRP ETF, but their iShares Bitcoin Trust crossed $50 billion in AUM. Their iShares Ethereum Trust crossed $3 billion. If BlackRock were to file and receive approval for a spot XRP ETF, and if it attracted even a fraction of the institutional flows their Bitcoin product captured, the math on available exchange supply changes radically. At the current exchange reserve level of 2.6 billion tokens, a single institutional order of meaningful scale doesn't just move the price, it creates a supply vacuum. The scenario being modeled by analysts is not speculative. It is the mechanical consequence of thin exchange supply meeting institutional scale demand in a compressed float environment. That is not a price target. That is supply-demand arithmetic. Now, before you read that as a pure bull case, there's something in the Fannie Mae announcement this week that has been misread by almost everyone covering it. And if you don't catch the fine print, it could change how you think about your own position's liquidity. That's next. 3 weeks ago, Fannie Mae made history through a partnership between mortgage company, Better Home and Finance, and Coinbase. Fannie Mae is now accepting crypto-backed mortgages for the first time in its history. Crypto owners can use their digital assets as collateral for down payments on home purchases. The stated goal? Make homeownership more accessible to younger demographics who are more likely to hold crypto than traditional savings. Max Brandsburg, head of consumer and business products at Coinbase, framed it as a major first step to unlocking homeownership for the younger generations that have struggled with barriers to saving for a traditional down payment. That's the headline, and it's genuinely significant. But here's what the headline doesn't tell you, and this is the part that matters for how you think about XRP as collateral. First, the loan-to-value haircut. Crypto collateral does not get valued at market price. Lenders applying collateral rules typically apply a haircut, meaning XRP at $1.42 may only be credited at roughly 70 cents to 85 cents. Depending on the institution's risk model. The more volatile the asset, the deeper the haircut. Second, liquidity lock. When you pledge XRP as mortgage collateral, That XP is locked for the duration of the collateral agreement. If XRP runs parabolically while your collateral is pledged, and you want to take profit, you may not be able to. The upside is inaccessible while the collateral is active. Third, this is a Coinbase-specific product right now. XRP is supported on Coinbase, but the collateral framework only covers assets Coinbase custody can certify for Fannie Mae's underwriting standards. The Fannie Mae development opens a $12 trillion mortgage market to crypto-collateralized lending. That is a structural shift in how crypto interacts with real estate finance. But the fine print matters before you pledge your XRP stack against a 30-year mortgage. And that brings us to the part most channels won't connect, because it requires being honest about the single variable. That ties every bullish scenario together. And right now, that variable is still unresolved. That's next. Here is the honest framework for understanding when XRP infrastructure translates into token price. There are three mechanisms that mechanically connect XRPL activity to XRP demand. Not narrative, mechanics. Mechanism 1. On-demand liquidity activation. Ripple's ODL product uses XRP as a bridge asset. It requires XRP to be bought, used to bridge, and sold on the destination side in seconds. That creates genuine spot demand. ODL cumulative volume has crossed $95 billion. Monthly ODL flows are above $15 billion. But only 40% of RippleNet partners use full ODL. The remaining 60% use messaging only, no XRP required. The moment Clarity Act passage makes XRP's commodity classification permanent in federal statute. The compliance barrier that keeps messaging-only partners from activating ODL drops significantly. Each percentage point of conversion from messaging to ODL is a direct demand driver for liquid XRP. Mechanism 2. XRPL DEX as settlement layer. 92% of trades on the XRPL DEX already route through XRP pairs. As tokenized asset volume grows, ARK's targeting $1 billion by mid-2026, Ondo Finance growing 293% this year. Market makers need XRP as working capital to quote prices. That is structural demand that scales with volume. Daily DEX volume at $4 to $8 million today is not the ceiling. It is the starting point. Mechanism 3. ETF custody locking supply. 773 million XRP already locked in ETF custody today. At $5 billion in AUM, JP Morgan's first-year forecast, 2.5 billion XRP locked, against a 2.6 billion exchange reserve. The math is stark, not a narrative, arithmetic. If you're tracking this kind of structural breakdown week to week, ODL activation rates, DEX volume growth, ETF custody mechanics, this is what XRP News Flow Signals covers every week. Subscribe if this is the level of analysis you're looking for. We'll be here with the next signal. Let's close the analytical loop with a framework. Not a single price prediction with an attached date, but 3 scenarios based on the variables that actually matter. Scenario 1. Clarity Act passes before May 21st. Blackrock files for an XRP ETF within 90 days. ODL activation accelerates as compliance barriers fall. In this scenario, Standard Chartered's $4 to $8 billion in projected additional ETF inflows enters a market with $2.6 billion in exchange reserves. XRP breaks $1.55 resistance, tests $1.90, and enters a price discovery phase with the first real institutional bull cycle behind it. Price range, $3 to $5 by late 2026. Wisdom Tree's 20x scenario, $55 to $60 per XRP, becomes a medium-term model, not a speculation. Scenario 2. Clarity Act delays past May 21st. ETF inflows plateau. ODL conversion stalls. XRPL DEX volume continues growing but doesn't trigger price. In this scenario, XRP tracks Bitcoin sideways, range-bound between $20 and $60 through most of 2026. The infrastructure thesis remains intact. The price thesis is deferred to 2027. Scenario 3. Clarity Act fails in 2026. This is the tail risk. Without statutory permanence, the compliance barrier for institutions doesn't fall. ODL activation slows. ETF inflows plateau. Price tests 82-cent support. The model Standard Chartered flagged. The variables that determine which scenario materializes: Senate Banking Committee markup before May 21st, WARSH confirmation, and Fed supervisory posture on digital assets. Blackrock's XRP ETF filing timeline. 3 variables, all in motion this week. Here's the complete picture. The XRP Ledger added more tokenized assets in 2 months than all of 2025. That is documented. Goldman Sachs holds $154 million in XRP ETFs. ARK Invest makes XRP its 3rd largest ETF position. Fannie Mae just opened the $12 trillion mortgage market to crypto collateral. The XRPL is processing 3 million daily transactions, 3 times mid-2025 averages. And the price is down 30% year-to-date. That is not evidence that the thesis is broken. That is evidence that the mechanism connecting infrastructure to price, ODL activation, DEX volume, ETF custody compression, is still in the activation phase. Not the speculation phase, not the waiting phase, the activation phase. And the specific catalyst that accelerates activation across all 3 mechanisms simultaneously is regulatory permanence, the Clarity Act as statute. When that arrives, and every signal from the Senate Banking Committee, from the White House, from the WARSH nomination, and from the 120 companies that signed the April 23rd letter suggests it is closer than the price implies. The gap between what is built and what is priced does not close slowly. It closes in the way gaps like this always close, when infrastructure meets institutional mandate. Quickly, and without a warning candle. Watch the Senate Banking Committee calendar. Watch the WARSH confirmation. Watch ODL activation data in Ripple's Q2 market report. Those 3 data points will tell you more about what happens next for XRP than any price chart currently available. This is XRP News Flow Signals. Data, not hype, every time.